If you've been concerned about allocating money to your portfolio's bond position for the last 15 years, it seems to be time to revisit that asset class. The chart pictured here is a monthly chart of stocks relative to bonds going back to 2010. The circled areas show times when stocks got very overextended compared to bonds. The years following these overextensions had a reverse outcome where bonds outperformed. It appears we are again entering that type of market action. I want to say first that if you were affected by the Silicon Valley bank collapse, I am sorry that happened to you. Historically, money in the bank has been very safe, and this is really unprecedented in the US system, at least in recent memory. I don't believe anyone knows for sure what ripple effects the collapse of Silicon Valley Bank may have, but it does seem as though this is the first semi-Main Street-ish thing to break as a result of the Fed's aggressive rate raising. Until something else changes, however, we need to keep operating under what history suggests about relative performance of bonds to stocks after high inflation, rising rates, and yield curve inversion like we have now. And they all suggest bonds will outperform stocks for the foreseeable future. We are in a contraction of the business cycle, likely stage 1 at this point. We should see bonds start to recover as we are already nearing the top of the tightening cycle. Yields are decently high, and any new money would be buying a high yield and the potential for price improvement if rates cool off. I think the SVB event also shows the need to practice good asset allocation and risk management by not overcommitting to any one asset class. The stock of this company pretty much went worthless in 2 days. There wasn't really any warning from any of the stock analysts, so how would an average investor do any meaningful due diligence? Stocks have returned decades worth of returns over the last few years. It just seems a reallocation might be prudent anyway. I'm no expert in what happened to SVB, but like most people on the internet, I'd be happy to speculate a tad. So imagine you're Silicon Valley Bank the last few years. You want to attract startup and venture capital money, so you try to offer high rates, at least for that time period, than most other institutions by purchasing long-term bonds. You think the risk is low because rates have been zero for something like 15 years now. But then suddenly inflation is exploding, and the Feds begin raising rates aggressively. Your long-term bonds go down in value significantly since rates and price have an inverse relationship. In addition, the yield curve also inverts. So now short-term and medium-term bonds are paying a higher yield than your long-term bonds. So in addition to your capital losses, your yield is significantly lower than you could get in the open market now on shorter-term holdings. Customers also realized they could get higher rates now on short-term things like CDs, treasuries. Then SVB announces a $1.8 billion loss in sales, were not able to secure funding, and customers began to withdraw deposits rapidly. This is commonly known as a bank run. The last US bank run was really associated with the Great Depression. If anyone tells you for sure they can accurately predict how far-reaching the impact of these events will be, I'd remain skeptical. The psychological aspect is really hard to predict. At any rate, though, it's clear. It's clear that Tina is dead. Yep, I said it. May she rest in peace. Tina was the mantra for the last 15 years or so. It stands for there is no alternative. It refers to there being no alternative to invest in for yield and real return except for risk assets like stocks, mostly due to the zero interest rate policy because the Fed was trying to target 2% inflation. It was a time of continuous quantitative easing, aka money printing, where the money supply was increasing and cheap money abounded. When money is cheap and it's easily accessible, money finds its way into speculative assets and zombie companies that don't really have real profits. We saw all kinds of evidence of this in many areas of the US economy, with companies and assets that have returned many multiples in a short time period. But we went from cash is trash in 2022 to cash is king pretty quickly in the last few months. I just got an offer from my credit union for a certificate of deposit that's paying 5.5% for a 7-month CD. US Treasury I bonds aren't quite at their high of 9% or whatever they hit, but they are paying 6.89%. Now, not all of these things are beating inflation yet, but the Fed states they will continue to raise rates for higher and longer until inflation is back down at the 2% target. Now that money is not so cheap anymore, it appears it will continue to get more expensive to borrow with higher rates to nip inflation in the bud. That's applicable to regular people and also to businesses. In the years preceding the zero interest rate policy, bonds served a really useful purpose in a portfolio, even for those in the accumulation stage. There have been times in history where bonds have outperformed stocks, so it would have been beneficial to have an allocation to bonds to be able to rebalance into stocks when they are down. Bonds also help to increase returns and reduce overall portfolio volatility. Bonds at one time were considered more of an inverse or loosely correlated to stocks. There have also been long periods of time, as in 10 plus years, where stocks trade sideways. Bonds would have helped during that time to add additional income to the portfolio for reinvesting also. It appears now that once again bonds are poised to outperform stocks from a relative standpoint moving forward. So is now the time to devote or redevote a portion of your portfolio to this recently shunned asset class? History would seem to suggest so. What is a bond? It might be easiest to think of a bond as something you've likely experienced, borrowing money. Whether you borrowed for a student loan, auto loan, or mortgage, that is the same concept as a bond. You needed a loan. A bond is a way for a company or government to raise cash and aka get a loan, just like you needed one. It's debt that they incur. The repayment structure is outlined and issued on the issued bond. It has a specific maturity date, which tells the time period. Just like when you go to borrow money for something, the company or government is judged based on their credit worthiness. The credit worthiness for a company corresponds to a letter grade and can determine the interest rate that they pay. Bonds are typically rated on a lettering system from A's and B's, being high investment grade to high yield or junk bonds in the letter C's. For the federal government, they are not graded by letters, but instead, they just say they're backed by the full faith and credit of the U.S. government. You'd be surprised how hard it is to find a legible picture of anything other than a government bond online. But anyway, here's a picture of a U.S. savings bond as an example. You can see the face value is $50. The value was different. It would say 50, 500, 1,000. The issue date in this case is 2005. In fine print in the upper right corner here, it says it can continue earning interest for 30 years. Other bonds that don't go on earning interest indefinitely will list an actual maturity date on the bond. This Series I bond does not have a rate listed on it because there are two parts, a fixed rate and a floating rate that changes every 6 months, but a corporate bond would list the coupon rate to show how much they're paying. There are many different types of bonds, but two main categories from a tax perspective, taxable and tax exempt. Tax exempt bonds typically come from municipalities. They're referred to as municipal bonds or munis. The decision of whether you should buy taxable or tax exempt bonds mostly falls to your marginal tax rate. You'd want to compare the after-tax yield to the tax-free yield to determine which makes more sense for you. After determining whether taxable or tax exempt makes sense for you and your account type, there are many types of bonds. Short term, which is 1 to 3 years, medium term, which is 5 to 7 years, long term, which is 10 years or longer, typically up to about 30 as the max. There's inflation protected bonds, there's mortgage backed bonds, floating rate bonds, there's international bonds. I cannot possibly cover all these in detail, but in general, a good place to start would be a core bond index mutual fund or a bond index ETFs. That will give you a lot of exposure to a variety of industries and companies in one fund represented by thousands of bonds inside of it. These bond funds are typically considered investment grade. In general, bonds are rated A through C, with A being investment grade, B being non-investment grade, C being junk. You can think of these similar to credit scores: excellent credit, average credit, poor credit. In 2008, there was a mortgage-backed security meltdown. Great financial crisis. Many of these bonds were rated A. They were thrown into things called tranches with other loans that were not A, but everything was packaged as A grade and sold off to investors in the secondary market. That's basically what started the crisis. But it did call into question the rating systems because there was sort of a pay to rate system in place, and that definitely hurt the credibility of the raters. So why is now not chasing yield? Well, the Fed has already done the majority of the hikes. The bond market tends to price in future hikes in advance, and they've priced in, a 25 basis point hike already. If the Fed can really make it much higher, the amount that the US government is paying on its debt is going to become unmanageable. It's pretty much already there. It doesn't seem like there's a whole lot more room that the Fed can raise. If they were to lower rates again in the future, then bonds would benefit because the price of bonds would go up. Just keep in mind when interest rates go down, price goes up. So bonds have pretty much already gone through their downtrend. Not to say they can't continue a little lower. It is not crucial to get the highest yield possible with every dollar that you have. Diversification among asset class types really seems prudent. When you put many bonds together in a bond fund, it gets a bit more complicated than individual bonds because each one added or maturing will impact the makeup and characteristics of that fund. Bond funds and ETFs also trade as securities. I'll give some examples of bond mutual funds and bond ETFs, including some ticker symbols in a bit. Bond mutual funds only price once a day at the market close, just like other mutual funds. Bond mutual funds are typically what are offered inside your workplace retirement plan, your college savings plan, your health savings account. If you put a buy or sell order in during market hours for a bond mutual fund, it does not purchase real time. It waits until the share value is calculated at the end of the day after market close. In contrast, a bond ETF trades real time during market hours, just like any other stock or ETF. Both bond mutual funds and bond ETFs, though, have key metrics you can use to judge if they make sense for you. The key metrics are the yield, meaning how much it's paying you, the average weighted maturity, which is the average of all of the maturities in the bond fund or ETF. It's typically measured in years. The average weighted coupon, which is the average of the various coupon rates on each individual bond, meaning the interest rate each one pays. And finally, the duration. And duration doesn't mean how long the bond's for. Duration tells you if there is an upward change in interest rates, how it will impact the price of the mutual fund or ETF. For example, duration of 4 years means that if there is an interest rate increase of 1%, on average it would take 4 years of dividends to recoup the loss of the price of the bonds, because the price of the fund or ETF would go down, through the income it spits out every month due to that 1% interest rate rise. The yields increase when rates rise, but it takes a long time to recoup the money through dividends. However, at this point, the major decline has already happened, it would appear. If you were to start adding new money now, it's not likely that bonds would experience anywhere near the downside they already have, which is why they seem to be an attractive investment, once again, at least compared to the other alternatives. As I mentioned, you likely already have access to money market funds and bond mutual funds in your tax-advantaged accounts, such as your retirement plan through work, health savings account, or college savings plan. These types of accounts typically hold mutual funds, and they have a 5-letter ticker symbol ending in the letter X. Here are some examples of money market funds you may have access to in your plans. Most institutions that act as custodian have their own money market funds end in XX for the ticker symbol. Outside of a tax advantage account, the cash or sweep position of a brokerage account is typically a money market fund, and the identifier ends in XX as well. These money market funds are now paying somewhere north of 4%, so if you already have a brokerage account, leaving your money in the cash or sweep position now earns you a decent return, as opposed to the 0% that those cash positions paid for the years prior in the zero interest rate environment. So before you take any additional risk above that money market return, make sure the risk to reward is going to be higher than that 4% that you're getting as pictured here on these funds. Some examples of some core bond mutual funds pictured here. Mutual funds have a 5-letter ticker symbol ending in only one X. As mentioned earlier, money market funds end in 2 X's. These core bond mutual funds pictured here are some of the examples of the types of funds you may have access to in your tax advantage accounts, and they could be useful as your core bond fund holdings. They're a good starting place before adding any complementary bond funds. Here is the list of bond ETFs by market capitalization. Bond ETFs have a 3 or 4-letter ticker symbol. BND and AGG are the ticker symbols of the largest bond fund ETFs, and either of these could serve as a core holding before you branch out into other bond fund styles and strategies. If you own a target date fund, you likely have a bond allocation already. Target date funds automatically increase your exposure to bonds as they get closer to the year that the fund lists. They get more conservative as you reach your retirement year. For example, target date 2025 funds would have a higher allocation to bonds than a 2045 target date fund. Here's an example from Schwab of how the allocation changes for you to become more conservative by switching to fixed income and cash equivalents. Fixed income and cash equivalents is just a fancy way of saying bonds and money market funds. You can see that over time, the equity exposure goes down, equity stocks go down, and when they reach the target date, your allocation to bonds increases as you age. Asset allocation funds are another type you may already have available. They have a set percentage assigned to bonds which remains constant over time, like 60% stock and 40% bond, for example. The most aggressive options have a smaller percentage allocated to bonds than the more conservative investment choices do. These do not automatically adjust as you age. You can see here some examples from Fidelity. They outline that risk increases as you increase your equity exposure. That's pictured right over here. Before buying any additional bonds, whether that's physical certificates, digital assets like ETFs or mutual funds, outside of your existing account choices, make sure to look into your certificates of deposit. CDs may offer you a better risk return for a portion of your money. They do not really have any early closure penalties anymore. The FDIC insurance covers up to $250,000 per account type and holder. You can also buy what are called brokered CDs in tax advantaged accounts as well. So some people are very risk averse and they'd want to put a CD inside of an IRA. You can do that with a brokerage account, and there's called brokered CDs you can buy. So just make sure you're maximizing tax advantage space whenever possible. If your emergency fund has been in a savings account for the last few years, it's really time to revisit a tiered emergency fund strategy since yields have improved so much. Maybe something like 1 month expenses buffer in your checking account, 2 months expenses in your higher yield savings account, 3 month expenses in a CD that you could break if you needed to, and anything else for emergency reserves and I-bonds. An emergency fund is there just to make sure you don't have to draw down from your investments at the worst time, aka when the asset prices are depressed, so it's also insurance and peace of mind. These are just examples. You could adjust these based on your situation and needs. If you're feeling calm, cool, and collected, you can try and purchase some I-bonds from Treasury Direct. It can be difficult to navigate, but if you can stand it, you can purchase up to $10,000 per social and tax ID annually. That's only if you do it electronically. Paper bonds are a limit of $5,000. Personally, I'd pick the I-bonds over the Series EE. They have a fixed rate and a floating rate, and as mentioned before, they're paying somewhere around 6.9%. As far as tax considerations, we always want to be tax conscious and avoid paying unnecessary taxes on any investment. In general, to ensure tax efficiency, reduce tax drag, and maximize returns, you want to put higher yielding investments like bonds in tax advantaged accounts, lower yielding investments in taxable accounts. Make sure to take advantage of as much tax advantage space every year as you can because you cannot go back in time later and contribute for past years. I hope I provided some value and how it might make sense to reallocate your investments to reduce your risk moving forward. I'd appreciate it if you liked the video to share with a friend if you think it would help them. I'm working on some more videos, so make sure to subscribe if you enjoy this type of financial content. Till next time.